After the biggest liquidation event in cryptocurrency history, what happens next could define the entire future of this market. The next 48 hours are absolutely critical, and I'm going to break down exactly what needs to happen for a full recovery. Because make no mistake, what we just saw wasn't a random sell off. It was one of the clearest examples of how controlled, automated, and algorithm driven this market has actually become. The truth is, we just witnessed how institutions can move billions of dollars in seconds. And yet, it's retail traders who end up holding the bag. This isn't financial advice. Now let's get into it. The last 48 hours have been nothing short of chaos. We're talking about one of the most violent and sudden crashes in crypto history, followed immediately by one of the fastest V-shaped recoveries we've ever seen. That alone should tell you everything you need to know about what's really going on under the surface. The entire event was triggered by a single headline, one that sent algorithms across Wall Street into full-on panic mode. Here's what happened. When President Trump mentioned tariffs on China, high-frequency bots that scraped global news headlines instantly flagged that word tariffs as bearish for risk assets. Those bots don't think, they don't analyze, they just react. The second the word hit the feed, they dumped everything tied to risk. That includes tech stocks, emerging markets, and of course, cryptocurrencies. Within minutes, billions of dollars worth of leveraged positions across the market were liquidated. But here's where things get interesting. When you looked closer, it became clear that there was no actual fundamental reason for crypto to dump that hard. In fact, tariffs historically benefit the case for decentralized liquidity, because when global trade becomes fragmented and unpredictable, neutral assets like XRP and Bitcoin actually become more valuable. So this sell-off didn't make sense. It was pure algorithmic reflex, machines reacting to headlines, not to logic. Now think about what happened next. As those same bots were dumping billions, the smart money was quietly buying. Funds, insiders, and deep-pocketed players saw what was happening and started scooping everything back up at a discount. That's why you saw that massive V-shaped recovery. They knew this wasn't a real sell-off, it was an opportunity. And that's exactly where the next 48 hours come in. Tomorrow, when institutional traders return to their desks, they're going to look at what just happened and realize their systems sold off billions based on a single word. A headline that Trump himself later walked back. He clarified that tariffs weren't actually being implemented, just threatened, which means the entire liquidation cascade was built on a misunderstanding. Now, before we continue deeper into the market breakdown, I need to tell you something important. Because if you want to truly capitalize on events like this, you need the right playbook. I've put together the XRP Millionaire Blueprint, which breaks down exactly how to spot these kinds of setups before they happen with a full document, an in-depth infographic, a step-by-step video walkthrough, and much more inside. If you're serious about positioning yourself for what's coming next in this market, you need to see it. It's all in the pinned comment below this video. Alright, back to what's unfolding right now. What we're seeing is the perfect example of a system that's become so dependent on automation that real analysis has left the room. Institutional algorithms are designed to categorize assets in simple binary terms. Risk or safe. That's it. They don't understand nuance and they don't understand innovation. They just react to stimuli. So when the word tariff appears, those systems interpret it as danger and liquidate. Everything labeled risk. That's why you saw tech stocks like Nvidia, Amazon, and crypto assets all get hit simultaneously. It's not that these assets suddenly became worthless. It's that they're grouped together by institutions under the same risk-on umbrella. The irony is, this exact mechanism creates massive opportunity for those who can stay calm and think clearly. Because when markets are being sold off for reasons that make no logical sense, that's when asymmetric returns are born. Now, let's zoom out for a second. What we saw over the last 2 days was the most aggressive liquidation cascade in the history of crypto. Billions in leverage evaporated in hours. Over-leveraged traders were wiped out. Exchanges saw record volume and funding rates flipped negative across the board. This kind of flush clears the system. It resets the playing field. When everyone who was overextended gets wiped out, it sets the stage for a more stable uptrend too. build. And that's why what happens on Monday is so crucial. If markets open and there's no further escalation in tariff talk, we could see one of the sharpest rebounds of the year, because right now institutional traders are sitting on portfolios that were rebalanced based on false information. They offloaded what they thought were risk assets, but now they're realizing they were reacting to a non-event. When they come back online, they're going to look at Bitcoin, XRP, and the rest of the crypto market trading at a discount. And the only logical move is to reposition back into those assets. You can already see it starting: liquidity, drying up on exchanges, bids stacking higher, and sell-side volume fading. That's not retail. That's smart money positioning ahead of a Monday reversal. This is also where conviction separates the winners from the rest. When volatility spikes like this, it shakes out those who don't understand what they hold. But for those who do, these moments become the best entries of their lifetime. Because despite all the chaos, the fundamentals of this space haven't changed. In fact, they've strengthened. Institutional adoption is accelerating, regulatory clarity is improving, and real-world utility, especially for assets like XRP, is expanding faster than ever. We're still seeing new banking integrations, cross-border testing, and infrastructure growth at a scale the market hasn't even priced in yet. And that's the part most traders miss. They see a red chart and panic. But when you step back, you realize this entire liquidation event was sparked by nothing more than an algorithmic overreaction. Nothing in the real world changed. No network collapsed, no major company defaulted, no new regulation came down. It was literally a headline, a word triggering a cascade of automated sell-offs. That's not weakness, that's opportunity. And historically, every time we've this kind of overreaction, what follows is a massive rebound. It happened during the COVID crash, it happened during the China mining ban, and it's happening again right now. Every single time, those who understood the setup and stayed calm came out far ahead. Now, I want to make something very clear. Markets like this reward the few who can think independently. When everyone else is emotionally reacting to headlines, the few who can analyze objectively, who can look at the bigger picture, end up being the ones who accumulate during the chaos. That's what's unfolding right now. The weak hands have been flushed out, the leverage has been cleared, the algorithms have already fired their shots, and the smart money, the ones who understand this game, are quietly reloading. The coming sessions will show us whether the rebound we're already seeing gains full momentum. If we see XRP and Bitcoin push 5 to 10% higher into Monday's close, that's confirmation that this was nothing more than a forced liquidation event, not the start of a deeper downtrend. And as we move forward, you'll notice a pattern. Every time these algorithmic sell-offs occur, they create larger and larger rebounds, because each wave of liquidation removes weaker leverage and brings in stronger long-term holders. That's how market maturity develops. We're watching that transition happen in real time. Institutions are learning that crypto doesn't behave like equities, and the ones who adapt the fastest will be the ones who dominate this next cycle. Because what's happening right now is bigger than just one event. This entire situation is exposing a fundamental flaw in how modern markets operate: the reliance on automation, the obsession with short-term reactions, and the complete lack of real analysis from institutions has turned financial markets into a reflex machine. And what that means for you, if you understand it, is that the volatility you're watching is not chaos. It's controlled inefficiency. It's a system that overreacts in predictable ways, creating setups for those who know what to look for. When you strip away the noise, what we saw during this crash was the same story that's been playing out for decades. Retail panic selling into institutional accumulation. The only difference now is that the process happens in milliseconds, driven by AI and algorithmic trading models instead of humans. These bots don't care about fundamentals or sentiment or even logic. They just follow the rules they were programmed with. And when their rules trigger simultaneously across different funds, you get exactly what we just saw: a massive synchronized liquidation that wipes out leverage and hands opportunity to those who are patient. Let's be real, this is not the first time this has happened. Go back to March 2020, when the entire global economy shut down overnight. The same algorithms panicked, dumping Bitcoin from $10,000 down to $3,800. And yet, in less than a year, it was back above $60,000. That wasn't because retail suddenly flooded in, that was institutional re-entry after the bots finished their liquidation wave. You see the same rhythm again and again. Overreaction, panic, reaccumulation, breakout. It's the same pattern, just with different catalysts each time. This time, the catalyst was tariffs. But let's be honest, tariffs have no meaningful impact on the intrinsic value of crypto assets. They don't change blockchain adoption, they don't change regulatory clarity, they don't slow down innovation. And they certainly don't stop the flow of capital into decentralized systems. If anything, they reinforce why decentralized liquidity is needed, because tariffs are a symptom of fragmented global systems, while crypto represents the exact opposite. A unified, borderless framework for transferring value. So the sell-off made no sense, but the bounce, that's the truth of the market revealing itself. If you zoom into the liquidation data, what's striking is how quickly bids came back in. Within hours of the drop, more than half the lost value was recovered. That doesn't happen in a market that's weak. That happens when strong hands were waiting for an entry and they finally got it. And the velocity of that recovery tells you just how much suppressed demand there really is. When markets snap back that fast, it means people were sitting on the sidelines, ready to pounce the moment irrational pricing appeared. Now this is where the next stage of the cycle begins. Because what happens after a liquidation event like this is a gradual shift in control from short-term leverage traders to long-term spot holders. The weak hands get flushed, and what remains is capital that's not afraid of volatility. That transition is what sets the foundation for sustainable moves higher. If you look at Bitcoin, XRP, and Ethereum right now, you can see that process underway. Exchange balances are dropping, meaning coins are leaving trading platforms and moving to cold storage. That's a sign of conviction. It's what we saw right before every major rally. People accumulating, not speculating. The most important part is that none of the long-term bullish catalysts have changed. ETFs are still on track. Institutional infrastructure is still being built. Regulatory progress is still advancing. And global adoption continues to expand. The difference now is that the market just reset itself. The excessive leverage is gone. The overly optimistic retail positions have been liquidated. And what's left is cleaner, stronger momentum waiting to rebuild. If Monday opens without any new escalation in tariff talk, expect that momentum to start showing itself immediately. Stocks will rebound, crypto will follow, and narratives will flip faster than anyone expects. The same media outlets that screamed crypto crash will start publishing headlines about crypto resilience. That's how it always happens. Markets overreact down, then overreact up. But beyond just this week's reaction, there's a bigger lesson to take from all of this. Algorithms are not invincible. They might be faster than humans, but they're not smarter. They can't understand nuance, and they can't price in innovation. So when the next major headline hits and the market reacts like it's the end of the world again, you'll already know the playbook. Identify whether the news actually changes the fundamentals. If it doesn't, then it's noise. And when the market overreacts to noise, opportunity is created. Now let's talk about why this particular event matters so much for the next phase of the crypto cycle. Every crash exposes structural weaknesses in the market. And one of the biggest weaknesses exposed this time was how heavily institutions still rely on categorizing crypto as a risk-on asset. They treat Bitcoin and XRP the same way they treat tech stocks, something to sell when uncertainty rises. But here's the thing. Crypto is evolving beyond that. We're starting to see a decoupling, slow but steady. You can already notice that the size and speed of these drawdowns are becoming smaller compared to earlier cycles, and the rebounds are becoming sharper. That's a sign that crypto is maturing. The more utility assets like XRP demonstrate, the harder it becomes to classify them as speculative. They're starting to move into the realm of infrastructure. And infrastructure assets behave differently. They hold value through volatility. This is why, despite all the chaos, the fundamentals of XRP remain incredibly strong. The partnerships Ripple has built across financial institutions, the pilot programs with cross-border payments, and the continued expansion of RippleNet all remain intact. Tariffs have nothing to do with that. Bots selling off risk assets don't change the fact that global money flows are still moving toward efficiency. And Ripple's technology enables exactly that. When you step back and view the macro picture, you realize something powerful. Every temporary sell-off caused by a headline is just another filter removing the weak from the market. It's like a cleansing process. Every liquidation event makes the market healthier because it wipes out unnecessary leverage and consolidates ownership into stronger hands. It's brutal, but it's necessary, and this time that reset happened faster than ever. The market liquidated billions and then rebounded within hours. That's resilience. That's a sign of deep liquidity and real demand. So, while the average trader is panicking, those who understand how this cycle works are accumulating. Now let's talk psychology, because that's the other layer to this. These kinds of events are designed to break confidence. When people see 30% drops overnight, their first reaction is fear. That fear leads to selling, which amplifies the move and creates the illusion that something is fundamentally wrong. But when the dust settles and you analyze the situation logically, you realize nothing's changed. And that's when you understand why seasoned investors always say volatility is the price of admission for exponential growth. You can't get 100x upside without living through 50% drawdowns. It's the nature of asymmetric assets. Crypto is volatile because it's early, it's disruptive, it's rewriting the rules of global finance. And that kind of transformation doesn't happen in a straight line. It happens through waves, crashes, consolidations, expansions. Each crash shakes out the unprepared and rewards those who kept their conviction. So the real question to ask right now isn't why did the market crash? It's who benefited from it, because someone always does. And if you study these patterns, you'll realize that the ones benefiting are the same entities who triggered the algorithms in the first place. They caused the panic, they scoop the lows, and they ride the recovery. That's how institutional capital operates, and they do it over and over again. But the difference now is that retail has access to more information than ever. The tools, the charts, the on-chain analytics, they're all public. Anyone can see when exchanges are being drained, when large wallets are accumulating, when volume spikes at specific price levels. It's all visible, and if you know how to interpret it, you can position yourself alongside the smart money instead of against it. That's why the coming days are so critical. If we see Bitcoin and XRP stabilize and grind higher, it's going to confirm that this liquidation was purely technical, not fundamental. It means the floor is solid and the move up will likely be violent because there's so little resistance left. All that selling pressure has already been spent. From here, the market will focus back on fundamentals: ETF inflows, regulatory progress, institutional custody growth, and utility adoption. These are the forces that define long-term direction, and those forces are still pointing one way up. The irony is these algorithmic panic events actually accelerate the transition toward maturity. Each one teaches institutions how crypto behaves differently. Each one proves that short-term fear doesn't change long-term reality. And each one brings us closer to a point where crypto isn't treated like a risk asset at all. It's treated like the foundation of the new financial system. And that shift is already happening faster than anyone realizes. What's happening right now marks a turning point, not just for crypto, but for how global markets will operate going forward. We just witnessed the system blink. For years, the narrative has been that institutional participation brings stability. But the last 48 hours showed the opposite. Automation has made markets more fragile, not less. Billions moved instantly based on a single word. And yet, within a day, the market corrected the mistake. That's not fragility for crypto, that's strength. Because every time these shakeouts happen, crypto proves it can't be killed. Look at how XRP, Bitcoin, and Ethereum behaved. The initial plunge wiped out leverage, yes, but what followed was pure accumulation. Exchange balances dropped sharply, meaning real holders bought that dip. It's a reminder that every crash in this market has a silent beneficiary. The ones who understand what they're holding aren't scared by volatility. They're energized by it. They see it as redistribution. Weak hands out, strong hands in. That's how cycles reset. And this cycle reset in record time. The selling was algorithmic. The buying was intentional. The only thing that changed was ownership. From traders chasing headlines to investors with conviction. That's why even after the largest liquidation in history, the structure of this market looks stronger than ever. And make no mistake, this matters for what's ahead. Because after a liquidity flush like this, markets tend to behave differently. Volatility compresses, leverage rebuilds slowly, and accumulation ranges tighten before the next expansion. That's the quiet stage, the one most people overlook because it feels boring. But it's during that calm that wealth is built. While the crowd is distracted, institutions are preparing for the next leg up. We've seen this movie before. After the 2020 crash, the same thing happened. Massive liquidation, weeks of sideways movement, then the breakout. The difference now is that crypto is more integrated into the global system than ever before. Back then, there were no ETFs, no major banks exploring custody, and no regulatory progress. Now all of that's in motion, which means when the next expansion begins, the scale will be far bigger. And this is where XRP becomes particularly important. Because while the rest of the market still trades on narratives, XRP's use case is tangible. Cross-border settlement is not speculation, it's infrastructure. The partnerships, pilots, and institutional testing continue to grow. Riplet is connecting regions that have never had efficient settlement systems before. That's real-world utility. And utility is what ultimately anchors price. So when people talk about volatility or manipulation, remember short-term moves don't change long-term math. XRP's liquidity corridors, its on-demand settlement potential, and its regulatory clarity give it a unique position in this next stage of adoption. Once the dust settles from these algorithmic events, the market always reverts to fundamentals. And the fundamentals here have never looked better. Now, let's talk psychology one last time. The market loves to test conviction. It always will. The only way to survive and thrive through events like this is to have a framework, a system that allows you to separate signal from noise. Because when you understand the mechanism behind the volatility, it stops being scary. You stop reacting emotionally, and you start acting strategically. Think about it. The same bots that sold off billions this week will be the ones buying billions next week. That's how algorithms work. They chase momentum. When they see green, they amplify it just like they amplified red. So, if Monday opens positive and the follow-through holds, you're going to see those same systems flip direction. The selling algorithms become buying algorithms, and the entire market momentum shifts in the opposite direction fast. That's why being positioned before that turn happens is so critical. You don't chase green candles. You identify when the selling pressure is exhausted, when the news doesn't match the reaction, and when fear is peaking. Those are the signals. That's when the smartest money moves in quietly while everyone else is frozen. And right now, that's exactly what's happening. The panic is over. The leverage is gone. The liquidity is rebuilding. The bots are resetting. The market is recalibrating for its next phase. Everything from here is about positioning, not panic. Because the truth is, moments like this are what build the next wave of millionaires. Not the calm, not the rally, the chaos, the volatility, the uncertainty. That's where the foundation gets built for exponential growth when the next cycle ignites. So, while everyone else is still questioning what just happened, those who truly understand the game are preparing for what's next. The opportunity is still here, but only for those who can see through the noise, keep conviction, and understand how to read the real signals in this market. And if you want to learn exactly how to do that, how to spot these setups before they happen, identify accumulation zones, and position for the explosive moves that follow. It's all laid out step by step inside the XRP Millionaire Blueprint. It includes the complete document, an easy-to-read infographic, a breakdown video, and more to help you capitalize on the next major shift. You can find it in the pinned comment below this.